Okay, so I'd like to begin our next session. This session will touch on the evolving role of the ETF custodian. Custodians are some of the unsung heroes of the ETF industry, and you can take it from me, they'll be playing an increasingly vital role to success in the future as we continue to innovate in the ETF industry. So I'm really looking forward to this panel personally and introducing Dom Dalmaso from Sound Capital Solutions to be our moderator. Thank you very much, Dom.
Thank you, Steve. Again, my name is Dom Dalmaso. I work as the CIO for Sound Capital Solutions, doing white label ETF advisory work with family offices, RIAs, and different asset managers. Also excited to introduce our great distinguished panel here, and I'll actually just kick it over here to John and let you go ahead.
Yeah, great. Thanks very much. Great to be here. Thanks, everyone. So John Houston from Brown Brothers Harriman. We are a global custodian and ETF service provider. I'm responsible for our ETF product team there. So working with our clients to bring new products to market, sort of our overall technology and service offering.
Morning, everyone. Paul DeSalvo from JP Morgan. I lead a lot of the ETF business development and sales efforts for the security services business. And Dom, I never had a chance to actually ask, but I wanted to suggest a new name for this panel, bringing the sexy back to custodians. So I think that's a good goal for today's conversation.
Perfect. Thanks, everyone. Morning. Pat Travers. I am not on the custodial side, but actually run the derivatives business at a firm called Clear Street. Within Clear Street, I'm the CEO of Clear Street Derivatives. And we'll see from the conversations, we do have a lot of overlap with the custodial network in terms of financing and leveraging within the ETF space within various products. So there's a significant amount of synergies, and our business is extremely dependent within the custodial network.
And good morning, Frank Adelka, Global ETF Product Specialist for State Street. Kind of doing the same thing John does at State Street.
And Paul couldn't have said it myself any better. So, obviously we've been talking a lot today about, different use cases and, again, to our point of the panel, evolving role of ETFs within the market. And particularly the underlying assets and derivatives has been a bit of a hot topic. So I think, Pat, that would be a nice place to start for you to, maybe understand where you sit as well as the role of the custodian when it comes to these derivative-based and defined outcome ETFs.
Yeah, sure. So from our perspective, as we mentioned earlier, we work very closely with the custodial network. We are a registered broker-dealer. We're a securities-based swap dealer. From an ETF perspective, we actually have the ability to be a custodian. We choose not to be a custodian, as the team up here will give more information and color in terms of the amount of effort, energy, work, systems, technology, people to build a custodial network. We don't, it's not a space that we compete in. So our role in the firm, for everyone's edification, Clear Street and Clear Street Derivatives is a 5-year-old company. It's a fintech-based financing company. That's acts as a prime broker, an FCM, securities-based swap dealer, derivatives transaction. We just launched in Europe. In the past week, we got our licenses from the FCA with sort of the same sort of business lines. So for this conversation, CSD, which is Clear Street Derivatives, is the entity which is a securities-based swap dealer. Obviously, one of a small number globally that is registered with the SEC. And our role is facing off with folks in this room, with other entities on the ETF side, whether it be an inversed ETF, a levered ETF, which have really come to vogue in the last few years, vol products, where vol products have to use a prime broker in order to custody, issue escrow receipts. There's a lot of things where it's great for us on our side, but working, because a lot of these funds and firms are 40 Act, working with our partners on the custodial side, they'll have to be custodied at a registered custodian. So us providing Clear Street the financing and the leverage and the derivative, whether it be a total return swap or whether it be an override strategy, super important. But again, working with obviously the custodian, where the collateral sits, looking at the the initial margin versus variation margin. We are massively dependent on the custodial network. Number one, to be there when we need them, Number two, to have the data being correct, because it's our capital and our balance sheet. So that's super important to us, as it is to the folks in the room and the folks who are managing the ETFs. And then working to create efficiencies to make these things a lot smoother, to make these things a lot more efficient. As I'm sure everyone or most people in the room are familiar, you've seen a pretty significant growth over the past few years within the space for whether it be single stock, levered, or portfolio or baskets that are thematic. My personal expectation is that we're at the very forefront of what this could possibly entail over the coming years for the industry. The amount of inflow and conversation we have around new product from existing clients, new clients just who are launching complexes, and then obviously everyone here is probably very familiar with the 800-pound gorillas in the marketplace, but it's been highly significant. And again, part of the ecosystem doesn't work without the efficiencies from a custodial perspective for, and this is for any swap dealer, right? They can have the best product front end in the world, but if you're not set up with the proper feeds, with the proper service, with the proper reporting on the custodial side, you have a pretty big breach in the system. So the growth is pretty interesting and exciting to talk about. The products are, when you look at XYZ launched with $3 million and they're now at $8.5 billion. It's astronomical, and they're going to 20. There is a massive behind the scenes component in it, and I can tell you that just from my seat, in the past 2 years, the amount of efficiency and sort of enrichment we've seen in the product on the custodial side, and a lot of folks may not see it. They look for their end of the day number. They look for their end of the day NAV. If it works and everything lines up, great. But the amount of what we've seen in the past 2 years with sort of the speed of the market has been dramatic, and my expectation is that'll just continue, as the business gets bigger, as the asset class grows.
That's great. And, I think a few things that we heard there was, obviously custodians are a very important and integral part of these ETFs behind the scene. But data flow, is interesting when it comes to issuers and managers. So maybe, we could have Pat, jump in there and talk a little bit about the data flow and integrations that you see over at JP Morgan.
Yeah, I'll take that one. And Pat mentioned before, data is critical, and not just from a buzzword sense, but from real-world information flow, connectivity, and communication over the course of the life cycle of an ETF. Someone in the panel earlier mentioned operational therapy as kind of a construct to think about how they spend their day. And I feel like it's a good way to illustrate what I do most of the time, talking to a new issuer, trying to explain the 24-hour clock of an ETF. I think one way to think about data is just over the course of the life cycle of an ETF, and if you want to start with trade date -1 to use our vernacular, there's a lot of information that's being disseminated outbound to the street. The issuers have obligations to the DTC, to the other streets participants, and very often the custodian or ETF service provider is providing and enabling that activity, whether it be enriching baskets, aggregating baskets, and delivering them ultimately out for authorized participants and market makers to hedge. And the quality and the robustness of that information is critical, because not only is it it's something good to have, but it could actually impact the marketability and the quality of your end product. And then if you think about on the inbound side, on trade date, there's a variety of information that's flowing into your ecosystem, whether that be through an instruction or order management portal, intent from the market with regards to actually engaging in the primary ecosystem. And then, often when we speak to a mutual fund manager, if you think about the cadence of information, a lot of times it comes from the issuer to the custodian. I think it's more of a novelty within the ETF ecosystem to think about in-kind transactions actually moving or almost reverse engineering into their own platform, and having to have traders and portfolio managers sort of get this information in real time or near real time and react to that. So it's just an example of some of the different facets in that chain of events and kind of that information flow that we spend a lot of time speaking with new and emerging issuers on.
I'll add one thing to that, which I think is super important and sort of echoes Paul's comments. When we think about three legs of the stool, if you will, you have the custodian. From our perspective, you have a swap provider or financing counterpart. and then you have the underlying client. There are a lot of moving parts with now. There's complexities that you start to see double bullet swap transactions where some of it's it's interest and principal. You have some where it's just interest only. You have some where the duration is 13 months. But like there's multiple different facets where there's resets, there's push forwards, there's termination events, and we've had instances where the data's got to align. And if client says, "Hey, we think the data is X," and we say, "Hey, we think the data is Y," and then custodian says the data is Z, like we've spent hours and hours and hours reconciling reconciling the the different data because we always think our data is right and the client always thinks their data is right, and then the custodian kind of thinks their data is right, but we always get to a solution. But like that sort of single source of truth, data integrity, obviously from a time perspective it's important, from a NAV perspective it's important, but it's something that is massively, and I'm sure everyone realizes this, but it's massively important to the end user, which in a lot of cases is obviously the the underlying purchaser of the agreement. But that's something that, again, in a 2-year period, I've seen it get it's gotten a lot better, which I think will only continue to occur.
I mean, I think the other thing too, right? Paul talked about the 24-hour clock of the ETF, but in addition, the 24-hour clock maybe of the derivatives transaction too, and right, and how do those things line up, and making sure that the right order of operation, so to speak, right? Of your creation redemption activity, you have the swap position or the options position that maybe you're sort of moving up or down based on sort of the other things that are happening, and how do those things all sort of stack together and come together to get to the right results at the end of the day.
Yeah, and it's from our perspective, and I'm sure everyone up here can attest to it. We'll get these are all, most of the products are market on close products, right, that are marked on the end of the day, and there's some days, and we've seen a little bit of volatility this year, but there's some days where the redemptions or creations are hundreds and hundreds and hundreds of millions of dollars, where it's a big transaction. Obviously on our side, we have to make sure that we're delivering properly to the custodian. And sometimes things occur where there's been nights, unfortunately, where we've had some of our operational folks in the office till 8:30 at night reconciling with the custodian because, like you said, it's next morning, it's go live. It's not like we'll figure it out T3. It's a 24-hour cycle, and it's between 3:30 when the orders come in, and then people they have the redemptions, they have their creations. It feels like a fast market daily, but it's just the structure of the business. But that's massively important.
Yeah, and on that topic as well, I think transitioning over into active ETFs, to your point of understanding that these managers are going to try to be, tactical and move within the day, as well as it even after hours trading. So maybe, we could jump into there and think about some, considerations for managers looking to do active launches.
Yeah, I mean, I think obviously tons of conversations in the market right now about active ETFs. $200 billion in flows this year, in a year that most people think is probably going to be a record for ETFs overall. So capturing roughly 25% of the flows on an 8% asset base, give or take. And I think roughly 75% of the new launches being active. So obviously a lot going on there, and really feels like we're at an inflection point, which draws a lot of interest. So we have lots of conversations with managers that are looking to enter the market. The panel before us, I think, was one such option that we have a lot of conversations about, right? Which is, I manage an SMA today. It's an active strategy. I'd like to potentially repackage that into an ETF. How can I affect, one of those 351 conversions to give my investors that great experience? Still conversations around mutual fund ETF conversions. Obviously there's 30 plus filings now for various managers that are looking to either add a mutual fund share class to their ETF, or an ETF share class to their mutual fund. Some actually looking to do both. So lots of options for market entry there, including just your sort of traditional, I'm going to launch an active ETF platform, and sort of set that up from scratch. So as we're having those conversations, so some of the points that were made previously, talking to what's the delta, right? So what's the net new from an ETF perspective, and some of that certainly is, hey, you might be used to instructing trades yourself as you're trading throughout the day, but how are you going to factor that create redeem into what you're doing? You're going to be using different types of baskets, so working with them on sort of what the options are that are available, certainly using custom negotiated, and sort of walking through that process, educating them on how that can work and how they can really optimize that, to reposition the portfolio, to be as tax efficient as possible. And I think sometimes, depending on the manager that you're talking to, those might be net new concepts, or at least things that were lower on the list, in their current environment, where maybe tax efficiency or tax sensitivity isn't at the top of the list. But then thinking about how you integrate those things of how do I use baskets most effectively when I am looking to reposition the portfolio, and what are those options available to me. There's a point made too about data. Certainly with active ETFs, the market is looking to consume data, around how they're trading, right? So it's not always going to be market on close, might be intraday. So you need to push out information about, P&L for some of that trading that you're doing intraday, to help sort of market makers, APs, price, those positions accurately, create, efficient markets and keep tight spreads. So I think those are a lot of the things that we end up talking about, with active issuers, and certainly there's many of them that are looking at the market and really thinking this is the right time for us to get in.
Just to dovetail on something you just mentioned, using the data again, kind of as the integral layer, is bond negotiation. Some of the tools and kind of the systemic connectivity between some of the the market leading negotiation dashboards, and kind of feeding that information into kind of the resident systems on the custodian side. Definitely becoming more prevalent, and active fixed income broadly, I think, is just exacerbating that trend.
Absolutely.
Yeah, and staying on the topic of launches and new entrants, Frank, want to throw this one over to you. What does it look like for somebody that's looking to, launch an ETF from a custodial perspective, as well as, considerations as a partner and a consultant that they're looking for from a custodian?
Yeah, I think the custodian has really taken on a role of free consultant. Like 15 years ago, active managers weren't even considering launching ETFs. And a lot of what we were doing was educating the boards, like, this is your competitor, you should be aware of it, you should look at the trends that are taking place. So a lot of it was more C-suite, like, just know who your competition is. But we've seen this acceleration of active managers now coming into the landscape. And the first issue they're faced with is ETFs are different than mutual funds. And a lot of these managers are used to the mutual fund landscape, they understand the ecosystem, and now they're going into foreign land. And the big three issuers used to seed all of the ETF issuers that were coming in second. So BlackRock, Vanguard, and SSGA their resources would be pushed out for opportunities. Well, now we have hundreds of active managers coming into the landscape. So a lot of them start off with no ETF expertise, and they look to the custodian to really bring them up to speed. So it's really doing day in the life sessions on an ongoing basis, really getting into the nuances, where we see barriers, where we see fail points for issuers, and doing that ongoing education. So it's created this whole new, I guess, service that custodians have to be aware of and have to support. And we think about it in the U.S. because that's where a lot of the attention has been around active, but it's happening globally. And we're seeing an acceleration in Europe. And we're seeing these same issuers that come with a strategy in one market travel other markets, and each of the markets are different. They might have some of the same ecosystem, but the buyers are different. Some of the nuances around market making and authorized participants are different. Some of the exchange reporting requirements are different. So it's doing a lot of that education. And again, you can go out and hire a whole ETF ecosystem into your shop. You can go out and get consultants, but in a lot of cases, the upfront work is done by the custodians because it's in our best interest for our clients to succeed in the market. So we want to make sure that we're providing a lot of that education so that they understand what they're getting into and really have a good sense of where failures and successes take place.
Yeah, just to add to that, Frank, it's interesting. We're seeing, from our perspective, obviously, with regards to swap products with custodial providers, partners, a lot of interest in companies out of Korea. So, Korean investors demanding it, and now we're starting to see more of our clients and new entrants kind of pop up to, there's a massive, obviously, sort of Korean investor demand for this product, and we've seen probably a dozen new recommendations come across in the past couple of months. So, we've seen a little bit there, not as much, but that seemed, we were there a couple of weeks ago, and the demand has been massive. So I think we'll continue to see, and the folks that we're in conversations with are spending a lot of time in, obviously marketing, branding in that marketplace, but also, kind of taking in what new product do you want to see, and then, I think it could be the next sort of, very interesting pickup in the space.
Yeah, and just to get back to Asia, Korea, it's two things happening there. They're buying U.S. products, and you see the exchanges now offering extended trading hours so that they can actually be buying in their time zone as opposed to waiting up at night and purchasing the ETF they want exposure to in the U.S. time zones. But it's also local products coming to market as well. So like Korea, it's unbelievable that it's only been about 4 years that active has been enabled, and 30% of the market is actively managed. So they've just seen this huge uptick. And we think the next big area is Taiwan. Because if you look at the pivot that's happened in Taiwan, 65% of the overall asset management industry is ETFs. 10 years ago, it was 5%. So the ETFs have eaten the whole asset management industry, but it's all been passive. It's been very successful both on the equity and the fixed income side. But now all these global managers that put a footprint into Taiwan as a local manager, they're seeing no flows into their mutual funds. So now that the regulator is allowing active, they're all getting ready to pile into the local Taiwan market as active issuers. So it's exciting.
That's great stuff. And I think, a couple questions that we were fielding here before we came up on stage was more about domestic regulation. So is there anything coming down the pipeline, from a custodial perspective that you guys have been hearing that may impact the ETF market as a whole?
I mean, I guess one sort of thing I find interesting, right? And I don't know, this is going to be too specific, but obviously we've seen sort of over the past 3-4 years, probably the greatest pace and frequency of new regulations that have come into the industry in quite some time, maybe if ever. And obviously with the regime change coming up, there's sort of the question of how many of those regulations might there be sort of an appetite to take a second look at and understand is there something that's going to be changed, maybe rolled back, maybe repealed, something new. So I just think it's an interesting time with sort of this change in leadership, likely change at the SEC and other areas within the government. We sort of went through a period of lots of change over a very short period of time, and what's it going to look like sort of 2025 and beyond, where maybe there's a different viewpoint on some of those things, and a desire to maybe do things a bit differently, and what is that going to mean for the ETF industry? I'm not sure, but I'm definitely sort of expecting that there will be some ramifications from that.
Yeah, and I'd say share class, and we talked about it earlier in some of the earlier panels, but it's coming. It's available in Canada, in Europe, in Hong Kong, in Australia, and it makes perfect sense for it to be enabled in the U.S. But I will say that there's friction there. Not only the regulatory friction with trying to figure out mutualization and will the ETF shareholder be harmed compared to the mutual fund shareholder, but the whole premise of doing an exchange from one share class into the other or a switch, Vanguard solved for that back in the day when they created share class because they have their own broker-dealer. So they have a captive broker-dealer. They own the transfer agency on both sides. Well, now you have all of these potential mutual fund managers that have a retail transfer agent and an ETF transfer agent. They sit on different systems. ETFs sit on DTC. The mutual funds sit on NSCC, networking and FundServe. How do you hop between systems? Well, the way we do it for mutual fund ETF conversions is it's staged on a weekend. So you do it on a Friday, you kind of let the dust settle, all the broker-dealers process the transactions, but it's onerous. So picture doing this on a daily basis at scale because, although share class is available in other jurisdictions, you don't have the tax efficiency benefit you get in the US. So that whole ability in a taxable account to do a tax-free exchange from the fund into the ETF is one of the drivers as to why you'd want to do share class. You can kind of separate your book as an asset manager. All your DC stays in the fund, and all of your ETF or your taxable accounts would go into the ETF. But it's not an easy proposition to do without a lot of industry participation. So it's incumbent on the custodians, the depositories to figure this out because we do see it's coming. It's probably 2026, just based on the pace of change. But I think that's the real custodian friction here, and it's not really custodian; it's more TA, but we're at the end of the day going to be responsible for solving it, because at the end of the day, this is going to be sitting on a custodial and administrative platform, and those switches will be taking place there.
Yeah, Frank, you bring up a great point. I think we talk so much about our version of custodians and the issuers, but it's really the intermediary that will probably put up the most friction and resistance. You know, and when you think about how long have we been talking about ETFs and 401k plans? One of the biggest, obviously, there's reasons and there's rationale why the benefits are not there in that structure, but a lot of it is the bookkeepers and the record keepers don't want to change. So I think you're going to bump up against a microcosm of that on this topic as well. And I would agree with you. As we do play a lot of hats in consulting and advocacy, it's probably going to fall on this ecosystem amongst others to figure it out.
So maybe one other interesting thing I'll throw out there, Frank, on the back of your comments, right, is we do see this structure in other markets. And in markets like Europe, oftentimes they sort of handle that potential for cross-class contamination with swing pricing, right? And so obviously swing pricing is something that's been discussed in the US from time to time. But if that is a tool that's sort of used today in other markets, you sort of wonder, is that something people might start to think about here? You know, if that's sort of one of the points of friction is how you sort of maintain that equitable experience across share classes for the different investor types. So just another interesting thing that might come down the road.
Great. Yeah, so we talked about different asset classes, data, obviously some regulations, and the other changes or innovations that are be coming down the pipe, you know, at least from the custodians that, you know, you want to share with the group, or any other ways to elaborate there?
I mean, there's no question the demands of processing more complex, more niche asset classes and instruments, that's not going away. And I think, you know, a lot of these are being put into fund structures now, and maybe in the primary market, you know, they're interacting cash orders. A lot of requests for in-kind futures, in-kind options, and in-kind whatever else. So I think that's only going to progress as people get, you know, a lot of the novelty that is, and the creativity that we lean as ETF people becomes more of a challenge for folks on the panel now. But I think it's a good thing long term, and I don't think that's going to stop anytime soon.
Yeah, we're starting, as I alluded to earlier, we're starting to see, you know, a lot more vol-based strategies, which obviously the demand in a volatile market, the demand increases on the buyer side. So we have you know, multiple conversations with no one on this panel, but from a custodial perspective, about escrow receipts and, you know, how the transfers work and how we look at the collateral movements. And, you know, we're in the process of like trying to explain to them the variations between, you know, OCC and DTCC, and they're not really certain, right? And it's, you know, it's not a brand new product, but it's newer. And it's not a small custodian, you know, but it's something that's just sort of not mainstream, where, you know, the math and the movements make total sense, but, you know, you guys know better than I, if it's not within the confine of your sort of daily, like here's how we operate 1 through 10, it's a little more difficult to figure out. But, you know, that's one example of, you know, things that are a little off the beaten path in terms of, you know, a new product that, you know, this one in particular has to, you know, deals with, you know, treasuries and escrow receipts, and, you know, it's actually causing not issues, but it's we have to kind of rework it with the custodian to be able to, you know, number one, offer it for this client, but then everything that we do, we want to scale, right? So you can't scale it if it's kind of everything's done by a one-off. But it's I think it's going to be more of the same moving forward. When you see more difficult, you know, you're going to see, as these markets continue to progress, you'll see, you know, different products, and you'll see different ideas, and you'll see different structures that won't be kind of the usual structure. So that's probably more in the future.
And I'd be remiss to not bring up the topic of our prior panel about 351 exchanges. So how would somebody come to their custodian, one, to engage about interest in a 351, and then ultimately executing on that exchange into an ETF?
Yeah, I mean, I can speak to that a bit. Definitely, we've had some experience there, and actually one in flight right now. So I think really a lot of it, you know, sounds basic, but a lot of it comes down to communication, right, across your SMA custodians. You know, is everyone sort of on the same page with which accounts are in scope? You know, what's the expectation around what's going to happen? Making sure that everyone sort of has all the pieces lined up, because it is a complex undertaking, right? There's lots of different folks that play lots of different roles, from the contribution of assets to the valuation to keeping track of cost basis to making sure that at the end of the day, those sort of SMA custodian records get updated with the right information for the new ETF holding. So there's a lot of coordination that needs to go, into place in advance as part of that planning effort. So I'd say that's probably the biggest one. But ultimately, from a custodian perspective, right, we're safekeeping the asset. So it's really about orchestrating that transfer of however many likely thousands or tens of thousands of positions are going to be coming into the new ETF sort of shell that they've established, and then issuing those shares back out to the investors and making sure that transaction is smooth and a positive experience for the end investor, because there's likely nothing more sort of unnerving as an investor to look into your account and you have a certain level of assets on Friday, and if it's not there at the end of the day on Monday, that's likely concerning, and you're probably going to pick up your phone and make a few phone calls and wonder what's going on there. So
one thing I'll add is that I've noticed when you're speaking to institutional professionals from a mutual fund company, they have different standards around data quality and administrative records. And then when you're talking to a family office or something like that, you have the end customer that might be a little cagey about the particular activity, and that adds an element of kind of apprehension and maybe volatility in the product. So there is a significant education element on all sides. And I think also, maybe it goes without saying, having really robust project management from end to end across all the different key stakeholders is critical, because it really is, it takes a village, for lack of a better word. And there's going to be some cortisol, so, buckle in.
Yeah, and Paul hit it.
You said some cortisol?
Paul, I think Paul hit it right, and it's not just the SMA; it's also the mutual fund ETF conversions. And I know an earlier panel talked a little bit about that, and share class. We don't see those slowing down, because there is just some funds that make perfect sense as an ETF and not as a share class. So I don't think that we're going to see a slowdown. There's probably been about 110 of them or so over the last 3 years. And we know that there's a lot more piled up. And I think what the custodians have done pretty well is, number one, they work together, because some of these flip custodians, the fund or the SMA, are in different custodians and then moving into the ETF at another one. But we all have playbooks around it. So, not only the project management, but, this is the script as to how you actually orchestrate it. And it's not pretty per se, but it's organized. So, it's an event. It takes time. You have to deal with your distribution channel and your client and all of that communication, and obviously the regulatory environment as well. But it's very well orchestrated compared to, I'd say, where it was 3 years ago, where we were kind of figuring it out as we went along because it was innovative. But it's become pretty much a mainstream process going forward.
It's definitely in everyone's interest to make this feel as frictionless as possible as the industry continues to grow. So we were joking before the panel, like, there really is some great partnership and collaboration amongst all the firms. So I'm glad we're part of that.
And thank you for all that. And I think now would be a great time to open up to the room to see if anybody has any questions for the panel.
Hi. So the last 5-7 years ago, everybody was going bananas about blockchain, and blockchain was going to save the world and change everybody's life, and flying cars and everything. Some of the comments here today, especially the ones around having multiple parties trying to reconcile data, to me seems like a kind of a slam dunk application of blockchain technology. Can you guys talk a little bit about any efforts or anything you think about the near future about the application of blockchain within the custodian realm?
Yeah, we have use cases today. It's mostly around cash products, some on the fund side. I'd say in Europe it's a lot more advanced on the ETF side, and part of that is the regulatory environment. So there's cases that are being worked on that would enable the tokenization of an ETF to broaden distribution, and that's happening. There's cases that it's actually in place in Europe. I'd say the U.S. is probably going to be a little slower because we want to make sure that the SEC and other applicable regulators are comfortable before we jump in. But I agree. There's friction in the marketplace that blockchain could potentially eliminate. But it's really, as an industry, I think going slow and making sure that some of these live test cases work effectively before we jump in with both feet.
I mean, my personal opinion is I think you're going to see probably greater progress in the near term on the tokenization of assets versus kind of, reconfiguring an entire ecosystem because of collective action problems and things like that. But without question, it would streamline a lot of the things that we spend most of our day talking about.
And and I would say it's interesting from our perspective at Clearstreet. We have 259 engineers onshore, so it is a fintech company. We have pretty significant API connectivity to a lot of the high frequency trading firms, large multi-strat hedge funds. We're at the we have to wait for the custodians to be able to move on their side. So like we're thinking about it, more of the kind of larger, more quantity type folks all connect to us via API, and tokenization is something we're thinking about. But we're not JP Morgan, right? So when JP Morgan's going to mandate, okay, hey, we're going to now run our custodial business, and blockchain's a good intermediary here. It really boils down, and I spent better part of 20 years at large GSIB bank. You're on a quarterly review in terms of what your expenses are, what your revenues are, what your EBITDA is. So it's like, oh, great idea. It's going to cost us $3 billion to implement it. It's probably drag it on for as long as you can before you have to spend that money. So it's we're beholden to them, and it's kind of good to be the king, but we're kind of ready to go on our side. I think a lot of our a lot of the smaller folks we deal with, but we have to wait for these guys to be prepared and make the move.
In terms of the ETF share class proposals, and if that were to go through, and I know you had mentioned, kind of the nuances and making those equitable for the different investors in maybe a mutual fund side of the share class or an ETF, but would there ever be a circumstance or a situation where if an ETF issuer were using two separate custodians for their mutual fund business and their ETF business at that time, when they go to do that, that you would recommend that they keep the custodians separate for those two different sides of the business, or that only make things more complicated and they absolutely should consolidate to one custodian to make that process easier? And how much would you assist the ETF issuer in kind of subsidizing some of that new infrastructure that they'll have to do for the accounting of both those different types of share classes?
Yeah, I mean, so I'll say one thing, Frank. Sorry, but I think I'll start by saying anything's possible, right? But when you sort of look at it, right, even though it's different share classes, it's still one fund, right? So if you did want to sort of split the custody across those things, then you're sort of managing potentially two different depots, right? Presumably you have one accounting agent at the fund level, and then sort of trying to reconcile across those positions. Frank mentioned earlier, you have potentially two different TAs, right? So sort of syncing together that flow data. So I'd say you'd have some challenges to think about if you wanted to sort of keep that bifurcated model. Not to say you couldn't do it, couldn't solve for those things. I'm sure they're possible, but likely I would say it is probably a simpler model with a single provider at the fund level, and then the share classes are obviously sort of sub that broader structure.
Yeah, we definitely have situations where the fund book is serviced by I'll just say hypothetically State Street, and the ETF is by another provider. I agree with John that the fund book should stay together in a sense, because you have accounting and custody considerations, and there's multiple providers that have more than one ETF service provider. So you want to try to create the least friction for the issuer. And to John's point, you can split it, but create more complexity and difficulty, which ultimately will probably have a knock-on impact to your settlements, which would impact your APs. You don't want spreads to widen because you have settlement issues going on. So you want to kind of keep the custody work consistent, because the custody that's taking place on the fund has a knock-on impact to the custody work taking place within the basket for the ETF. But you can have split providers. You could have standalone ETFs with one provider, but your funds that now as a share class should be with the same provider. So that's, I think, the considerations you'd want to make.
Any other questions? Raise your hand. You're doing a great job so far helping me meet my fitness goals. So the more questions you can come up with, the happier I am.
So maybe one last thing, that we can talk about, considering people are looking to, become entrants and, obviously utilize the structure. From the custodial perspective, what would be something that you guys would push back on for individuals looking to enter the market, and why that would be something, they wouldn't be interested in an ETF?
I guess one thing I'd just maybe put out there is just to say not every strategy is right for an ETF. A lot of them are. But sort of to Frank's point around consulting, right? Sometimes you start conversations, and as you get more sort of into the weeds and talk about how it actually might function, and you start to come across some challenges, and thinking about how you might overcome those. So you asked earlier about new innovations in the market, right? And I think one of the things we didn't talk about, but which I'm sure Frank can talk about ad nauseum, would be private assets, right, and private credit. Given what's going on there, right, and thinking about how does something like that fit into an ETF. Certainly there's regulations in place today that limit the amount, of illiquidity in a fund. But do some of those things change? Is there innovations around sort of pricing and availability of pricing data? It's going to allow market makers to make efficient markets in those, keep spreads reasonable. I think that's probably one of the things that we talk about a bit is sort of, it could be a great strategy, but if operationally it's not going to work within an ETF, is this really the right path to go down?
Question I usually ask up front too is like, be honest about what your ambitions are. It's very vogue to say that we're thinking about ETFs now. We're having that conversation, but how much resource, is it a long-term thing? Are you trying to catch kind of a quickly emerging trend? Is there a coherent distribution strategy? Like, I think the idea of like, if you build it, they will come, Kevin Costner style, like that's not going to work. So there has to be some real tailwind behind your approach and your strategy. So think through that ahead of time, and that'll kind of set the positive tailwinds for the rest of the project as it continues.
Yeah, I agree. I think same, from our perspective, we're a little bit different in terms of, there are some risks associated, especially with levered inverse, and there's just certain securities and asset classes that we're just, we're not going to participate in, right? There's the risk, significantly outweighs the reward. Not that there's difficulty from, custodial perspective, but it goes in, it's exactly what Paul said. It's like, there are a lot of things you can wish for, and there's a lot of things that, if you're trying to catch lightning in a bottle, it's not really a good long-term strategy. So our recommendations are always to think about things more strategic, longer term than sort of a quick fix that's going to, hopefully raise assets quickly and then, be a strike. So that's relatively the same.
Yeah, and capacity constraints are, I'd say, the biggest showstopper. So if you have a fund that you shut down because of capacity concerns, you can't do that with an ETF without flipping it to a closed-end fund, which you're probably not going to want to do when you open it as an ETF. And illiquidity, can be overcome. It's just a matter of, like, what do you really want out of the strategy? So some of these private market products, they're theoretical at this point. There's not really a good private market example of a fund that's out there. But we do like to use the analogy of fixed income. Before fixed income became a regular use case within ETFs, the fixed income market was extremely opaque. It was hard to price. You didn't get intraday pricing. And now ETFs have really become a price discovery tool for them. So you can solve for a lot of these issues. And generally, a custodian is not going to say no out of the gate, but they're going to ask these questions about what are you trying to accomplish, and do you understand the implications of having more liquid assets in a portfolio, harder to price assets? What is that going to do to spreads and your underlying investor experience? So it's more conversations.
And I guess lastly, I think what we can do here is, we're obviously on the industry track, and there's various service providers and industry professionals around the room. So maybe I'll, give the panel an open forum to, address anything, within the service provider community. Hopefully not air any grievances, but, get something out there to the group.
Yeah, I'd say the one thing about the custodian is we really sit between our client and their client, the authorized participant and market makers, and it's extremely important to get that right. And I think all of us have been trying to take as much friction out of that process away as possible. So like utilizing APIs for the create redeem process. The, the APs do not want 25 different portals to enter their create redeems into. They want to hit their trading system and have that record flow seamlessly. So the use of technology and digitization, I think, helps there. The fact that they have to post collateral when they have failing securities is not fun because the market makers actually have to widen out because they're using balance sheet and capital. So our ability to be as frictionless as possible and making sure that collateral is returned timely and accurately to close out fails, I think is job one because ultimately the tighter these spreads are, the better the experience for the APs and market makers, the more enjoyable experience for the end shareholders and our clients. So we try to act as a fiduciary, not just to our clients, the contractual clients, but also to their clients because that's what really makes the industry hum.
Yeah, I would agree with Frank, and from like I mentioned earlier, from our perspective, we're a relatively new entrant as a securities-based swap dealer with a pretty it's all public, you guys can see it, but a pretty significant share of the inverse levered ETF space, and we've already had multiple conversations with folks in the room about being partners and things that we don't do and things that they do that we can partner up because I think there's enough. There's a significant amount of growth, and we've all seen various, cycles in the industry, no matter, whether it's, over-the-counter trading, decimalization. We can age ourselves if you want, but there's a lot of growth here in the next 5 years from our perspective, and there's a lot of participants that want to kind of stick to their what they're good at, right? What they're going to do. Like I don't think there's anyone who wants to be all things to all people and be an LMM and be a swap provider and a custodian and an execute just maybe JP Morgan, but anyone outside of that, it's a lot for people to specialize in, and I think people who have been specialists in specific areas do those jobs really well, and the ability to sort of partner together, has been pretty significant. I think that'll continue.
I'm going to steal a few words you used there. So, and neither one of them's Paul. Find a partner with perspective, and if you have aspirations outside the U.S., there's a lot of insights to be rendered. To Frank's point, for free, at least up front. Though maybe we should think about billable hours or something like that. Certainly at my firm, we're very proud of touching all aspects of the ecosystem and being able to, bounce ideas off of our own partners that have the same email handle. So. It goes without saying, we're here to help. Everyone is better off by working together and collaborating.
Yeah, I guess I'll risk sort of overlapping on some of the other comments, but I definitely agree. I think an expanding industry, a larger pie is good for everyone. We talked about some of the things maybe a few years ago, things like estimated ETF conversions, and we're sort of figuring out as we go, or mutual fund ETF conversions, figuring out as we go. Getting things in place, with folks like Pat and his company around what's the most efficient way to sort of collateralize derivatives and things like that, or the APs, working with them to put APIs or efficient means to place orders most effectively. So, I think all those things put together are really, a lot of the times evidence of cross collaboration, right? Whether it's folks up here, custodians talking about how we do it, if assets are moving from one custodian to another, working with different trading firms, working with different APs. I think that shared knowledge and sort of that baseline of, this is sort of the best practice around how you do some of these things, how the industry can get more efficient. And I think that's a really good or strong area of collaboration, that I've definitely seen and expect to continue as there's more innovation in the industry and there's more need to sort of agree on best practices and common solutions.
So unless any last second questions or comments have come up.
Tom, I have one for you.
Oh, yeah.
Did we bring the sexy back?
I would say so. We're going to take a poll after, but I think lunch is coming up. We can figure that out.
Paul, I think you guys definitely made a great strides in bringing sexy back to custody. You've inspired me so much that I'm actually thinking, how do I bring sexy back to facilitating? Yeah, that sounds really weird. Forget it. Thanks, guys. Dom, thanks for facilitating the conversation.